Welcome back to Prosperity on the Horizon, the podcast that transforms businesses through the power of numbers. If you are listening to this podcast, chances are you are already on your way to exploring your numbers with a desire to understand and master your business finances, realizing the transformative power that numbers hold for your business success. Hello and welcome back to the podcast. I am so glad you are here today, as always. Today's episode is one that I have wanted to do for a while, because I hear this story so often, and I know it needs more attention. So imagine that you had a great month. Your revenue was up, you were busy, your clients were happy, and yet somehow you still felt financially tight. Maybe you hesitated before paying a bill. Maybe you transferred less to yourself than you planned. Maybe you just had that nagging feeling that something did not quite add up. And the question that sits with you afterwards is this: if that was my best month, why did it not feel like it? And that question deserves a real answer, in my opinion. Not a vague one about cash flow, not a lecture about budgeting, but an honest, practical explanation of what is actually going on behind the scenes that you may not necessarily be aware of. Because once you understand it, the feeling does not have to keep coming back. So that is what we are unpacking today. And there is a myth about this as well. If my revenue is up, my bank balance should feel better. So let's start with the belief that sits underneath that tight feeling. And it is a very understandable one. The belief goes like this: if I earned more this month, I should have more money, because when revenue goes up, the bank balance should go up too. It's that simple. But that is not how it works in business, and nobody tells you this clearly enough when you are starting out. Revenue is not the same as cash. They are related, but they are not the same thing. And the gap between revenue and cash is where that tightness comes from. Here is a very common scenario. You have a strong month, let's say $25,000 in invoices sent, but $8,000 of that is still outstanding because two clients have 30-day payment terms. Meanwhile, you had a quarterly software renewal, your BAS was due, you paid a contractor, and super came out. All of that happened in the same month. So your revenue looks like $25,000, but your actual cash position is completely different. When you look a bit closer, you realize that it's all about timing, and timing is the thing most business owners do not think about until they feel it. Revenue tells you what you earned, cash tells you what you actually have, profit tells you what you kept after expenses. These are three different numbers, and all three matter. The mistake is treating revenue as the headline and ignoring the other two. When you only watch the top line, which is revenue in this case, the bank balance will always feel like a surprise, sometimes a good one, but sometimes not. So what does this actually look like in real life? I want to share a pattern I see very regularly. And again, I will keep the details general, but this is a real and common experience. A business owner I worked with had been running her consultancy for 3 years. She was working very hard, had a steadily growing client list, and earlier this year she had her highest revenue month ever. She sent me a message the following week that said something along the lines of, "I do not understand it. I had my best month and I still feel broke. What is wrong with me?" Of course, there's nothing wrong with her, but when we sat down and looked at the numbers together, a few things became very clear very quickly. First, two of her largest invoices, which together made up nearly a third of that month's revenue, were still unpaid. The work had been done, the invoices had been sent, but the cash had not arrived yet. The second thing was that the same month she paid her annual insurance renewal, a quarterly subscription bundle, and a contractor she had brought in to help with a big project. These were three expenses that do not show up every month, but all landed in the same one. And the third thing that actually surprised her the most was that she had not set aside any money for tax that month. Not because she forgot exactly, but because she had been so focused on the revenue number that she had not thought about what would eventually need to come out of it. So that headline revenue number of, let's say, $30,000 looked great, but the actual cash that had moved into her account that month, minus the irregular expenses, minus what she should have set aside for tax, looked very different, much tighter, in fact, uncomfortably tight. She did not have any problem with her business, but she was running her business from the revenue number and the bank balance and not looking at the full picture in between. Once she started doing that, once she could see the timing of her income, the pattern of her expenses, and the real state of her cash each month, the tightness did not disappear overnight, but the anxiety around did, because she understood what she was looking at, and that changed everything for her. Okay, let me break this down practically, because I want you to be able to look at your own numbers after this and actually identify what is going on in your business. There are 5 main reasons a strong revenue month can still leave you feeling financially squeezed. And most of the time, it is a combination of more than one. So, reason 1, your cash has not arrived yet. This is the most common one. You have done the work and sent the invoice, but your client has not paid yet. That invoice is sitting in your receivables. It counts as revenue on your profit and loss, but it is not in your bank account yet. If you have clients on 14-day, 30-day, or even 60-day payment terms, there will always be a lag between what you earned and what you have. And this is completely normal, but it is worth knowing which invoices are outstanding at any given time and following up on them consistently. Reason number 2, irregular expenses landed this month. What does this mean? It means that some expenses do not show up every month, like annual renewals, quarterly insurance, a one-off contractor, some equipment you purchased, a course or event you invested in. These are all real and legitimate business costs, but when several of them land in the same month as your best revenue month, they can eat into your cash in a way that feels a bit too much. The solution is not to avoid these expenses, but it is to anticipate them. When you know what is coming, what you can expect, then you can plan for it instead of being caught off guard by it. Okay, reason number 3. Tax has not been set aside. This one is quiet, but it causes a lot of stress. If you are GST registered, a portion of every invoice you send does not belong to you. It belongs to the ATO. And if you have had a profitable year, income tax will come to you as well. If you are not proactively setting money aside for tax every single month, then every dollar sitting in your bank account feels like yours until it suddenly is not. I always recommend a separate tax savings account. Even moving a percentage of every payment you receive into that account, it makes a significant difference to how secure your cash position feels. Reason number 4, your expenses have grown quietly. This one catches a lot of business owners by surprise. When revenue grows, expenses have a way of growing alongside it, often without a conscious decision being made, because it may mean more software, a bigger team, upgraded tools, more marketing spend. Each one felt like a reasonable decision at the time when you made them. But when you look at what your expenses were 12 months ago compared to what they are today, the increase can be significant. If your revenue has grown, but your profit margin has stayed the same or shrunk, this is usually why. Revenue growth without margin awareness does not build financial security. It just creates a bigger version of the same tight feeling. And we got to reason number 5. You are running the business from your bank balance. And this is the one that ties all the others together. When the bank balance is your main financial reference point, you are always working with incomplete information. The bank balance does not show you what invoices are outstanding. It does not show you what expenses are about to land. It does not show you what is owed to the ATO. It just shows you what is in the bank account right now. And that is not enough to run a business confidently. It is like trying to navigate with only a rearview mirror. What you need instead is a clear picture of your revenue, your profit, your cash position, and what is coming in and what is going out over the next few weeks or months. When you have that, the bank balance becomes one piece of the puzzle rather than the whole story. So now that we know why this happens, let's talk about what to actually do about it, because understanding the problem is only useful if it leads somewhere. Okay, I have 5 practical steps for you. Step number 1. Run your profit and loss report for last month. Open your accounting software and pull the P&L for the previous month. Look at your revenue, look at your expenses, and look at what is left. That's the bottom line, your profit. It is the number that actually matters. If your revenue was strong but your profit was thin, something in the middle in the expenses needs attention. Step number 2. Check your receivables. How much money is sitting in unpaid invoices right now? Which clients owe you and how overdue are those invoices? Outstanding receivables are one of the fastest ways to improve your cash position. It should be a priority to collect what you have already earned. If there are invoices sitting beyond their due date, simply follow up this week. A polite, professional email is all it takes most of the time, but you can also set up automatic payment reminders in your accounting software like Xero. So once an invoice becomes overdue, these reminders will be automatically sent to your customers, reminding them that there is an invoice to pay. Step number 3, look ahead at what is coming out next month. Take 10 minutes and write down every expense you know is coming in the next 4 weeks. These can be regular ones, irregular ones, anything you are aware of. Then look at your expected income for the same period. Does the timing line up? Is there a week where more is going out than coming in? Because seeing this in advance is going to be a game changer. It means that you can plan around it instead of reacting to it. Step number 4, set up a tax savings account if you do not have one. This week, not next month, not when things come down, this week. Open a separate savings account and label it tax. Every time you receive a payment, move a percentage straight across. For most service businesses, starting at 25 to 30% is a reasonable guide, but speak to your accountant about it. What is right for your situation? The point is to make it automatic so that the money never feels like yours to spend. Step number 5, commit to monthly numbers check-in. 1 hour once a month, that is all it takes to stay across your numbers properly. Not to become a bookkeeper or an accountant, but to know what is going on in your own business. Your revenue, your profit, your cash position, your outstanding invoices, and one financial decision for the month ahead. When you do this consistently, the tired feeling starts to become much less frequent because you are no longer operating in the dark. And before we close, I want to leave you with a few questions. These are not meant to stress you out. They are meant to help you get honest with yourself about where you are right now. Okay, question number 1. When you had your best revenue month, did you know what your profit was? Not your revenue, your actual profit after your expenses. Question number 2. Do you know right now how much is sitting in unpaid invoices? Question number 3. Do you have money set aside specifically for tax, or is it all sitting in the same bank account? Question number 4. When did you last look at a full month of numbers, not just the bank balance? If you could not answer some of those questions easily, that is not a judgment. It is just useful information. It tells you where to focus. Because the goal is not to have perfect books or a complex financial system. The goal is to simply understand what is going on in your own business. clearly enough that you can make good decisions and stop being surprised by your own numbers. That is entirely achievable, and it does not require a finance degree, believe me. It requires a consistent habit and the right information in front of you. So here is what I want you to take away from today. A great revenue month is worth celebrating. Please do not let this conversation take that away from you. Growth is real, hard work is real, and when the invoices roll in and the clients say yes, that is genuinely worth acknowledging. But revenue is not the full story. It is the opening line. What matters just as much, maybe even more, is what you keep when you receive it and whether you can see it coming before it arrives. The tight feeling after a good month is not a sign that you are doing something wrong. It is usually a sign that you are running your business without full visibility. And visibility is something you can actually fix with the right habits and the right information. You deserve to feel as good about your finances as your revenue numbers suggest you should. And the way to get there is not to earn more, it is to understand more. So if today's episode made you think about your own numbers, the ones that you are not looking at as closely as you could be, I would love to hear from you. Send me a DM on Instagram at Horizon Accounts and tell me what came up for you. I read every message and I always write back. See you next week.